Hello and welcome to The Chart Show. Now, this week's three charts are the pound, McColl's and Rightmove. The Bank of England Monetary Policy Committee member Michael Saunders said that inflation could be higher than expected. Last week, the central bank raised interest rates from 0.75% to 1% and also forecast that inflation could hit 10% before the end of the year, which will be the highest level since the early 80s. Saunders also said the cost of living crisis could be bigger and last longer than expected. And that's why when the decision to carry out a quarter-point interest rate hike was announced last week, a third of the committee actually voted for a more aggressive 50 basis point hike to 1.25%, suggesting that the Bank of England is serious about tackling inflation. As a result, the pound has now slumped to a two-year low against the US dollar, the weakest level since July of 2020, extending recent losses. Part of that was driven by concerns about the UK's economy, but it was also driven by nervousness that's led to safe haven demand for the US dollar, which is considered to be a safe asset amid the general economic and market unease. Let's take a look now at the chart of cable because we can see the ascending trend line that came into play after the COVID-driven sell-off in the first quarter of 2020, with higher highs and higher lows, until the peak last year. However, since May of 2021, the pound has changed direction, largely against the US dollar, with that depreciation for the British currency accelerating over the last couple of months, with a steeper descending trend line to replace the earlier shallow one emerging. We can see the currency pair has touched two-year lows and has broken below support at 125 and is potentially on track to hit 120 as the next major round number support level to watch. Having said that, we are a considerable way above the 2020 trough, which is just below 115. Morrisons has confirmed that it will rescue the insolvent convenience store chain McColl's, beating EEG Group after final offers were submitted on Sunday. Morrisons will take on all 1,160 of McColl's shops and its 2,000-member pension scheme, alleviating fears about store closures and job cuts. Morrisons will also pay off its debts worth £170 million. Shares in McColl's were suspended on Friday, having lost almost all of their value since the start of the year. Given that Morrisons already works closely with McColl's as a key wholesale supplier, arguably this is a strategic fit that will provide Morrisons with access to 1,000 more convenience stores in attractive locations. There has been a major shift in supermarket behaviour over the last decade, from the once-a-week big family shop to several mini top-up shops throughout the week, a shift that McColl's store locations will help Morrisons to seize upon. Let's take a look now at the chart of McColl's. Even though it has been suspended since Friday, it's worth checking in to see how its recent problems have been weighing on the share price. Here's a look at the chart dating back to just before the pandemic at the start of 2020. We can see the stock peaked in June, so just under 2 years ago, and since then it's been facing significant selling pressure. Post-vaccine announcement in November, the stock recovered some lost ground, but after the peak in March last year, shares have pushed lower once again. The stock is down by more than 95% since then, representing the fact that it's now insolvent. And now it looks like it will become part of Morrisons, so no longer a standalone publicly traded company. Shares in Rightmove fell sharply on Monday, hitting the bottom of the FTSE 100 after CEO Peter Brooks-Johnson announced plans to step down after 16 years with the company. He's been at the helm since May of 2017 and will leave in February next year to help achieve a smooth transition. Rightmove is now on the hunt for his successor and said trading year to date has been as expected, with full-year guidance unchanged. Brooks-Johnson took the top job at a time when Rightmove was successfully growing alongside its share price. Under his tenure, the share price has gained by about 25%, faring particularly well during the pandemic as a stay-at-home stock, with many browsing homes online and thanks to the stamp duty holiday. However, it's also been expanding into mortgages, insurance, commercial property and others, helping to drive 67% growth in terms of operating profit last year. But like many stocks, 2022 has been very challenging, with the shares down 30% since the January highs, testing one-year lows, with the potential for further declines if the housing market starts to turn and interest rates push higher. Taking a look at the chart of Rightmove, we can see that after the COVID sell off in 2020, it managed to reclaim all lost ground relatively quickly, pushing above its pre COVID peak by the summer of 2021, and then continued that ascending trend line, peaking at around 812 before a sharp turnaround at the start of the year amid the global market volatility. We've now seen the stock retrace more than 60% of those gains, trading around support at the 61.8% Fibonacci retracement level around 540. If we continue to see the stock push lower, the next support level is likely to be around the psychological round number 500 mark, with a break below potentially paving the way for further declines.